How do changes in rupeezy labor laws impact stock market performance? Hello, market enthusiasts. Today, we're diving into a topic that often plays a crucial role in shaping the share market but doesn't always get the spotlight it deserves. Labor laws. Whether you're tracking the Adani Power share price or other stocks, understanding how changes in labor laws affect stock market performance is vital. Let's break it down in a conversational style, with plenty of pointers to keep things engaging. The connection between labor laws and the stock market. Labor laws are regulations that govern the relationship between employers and employees. They cover various aspects such as minimum wage, working conditions, employee rights, and collective bargaining. Changes in these laws can significantly impact businesses and, consequently, their stock prices. Here's how. 1. Impact on business costs. Increased operational costs. When labor laws mandate higher wages, better working conditions, or more benefits, companies may face increased operational costs. This can affect their profitability, leading to a potential decline in their stock prices. Investment in automation. To offset the increased costs, companies might invest in automation or technology, which can be capital intensive. This investment could be seen as a long-term positive by the market, but short-term costs might pressure stocks prices. 2. Investor sentiment and stock prices. Uncertainty in the market. Changes in labor laws can create uncertainty in the market, especially if they are sudden or drastic. Investors typically dislike uncertainty, which can lead to stock price volatility. Long-term versus short-term outlook. While stricter labor laws might negatively impact a company's profitability in the short term, they can lead to a more stable and satisfied workforce, which could benefit the company in the long run. This dual impact can cause mixed reactions in the stock market. 3. Sector-specific effects. Labor-intensive industries. Industries that rely heavily on manual labor, such as manufacturing, retail, and construction, are more directly impacted by changes in labor laws. Stricter regulations could lead to higher costs and reduced profitability, affecting stock performance. Tech and automation. On the flip side, companies in the technology sector might benefit from stricter labor laws as businesses turn to automation to reduce reliance on human labor. This could lead to a positive impact on their stock prices. 4. Global implications. Comparative advantage. In countries where labor laws are more relaxed, companies might enjoy a cost advantage over those in countries with stricter regulations. This could affect their competitiveness and, in turn, their stock prices on a global scale. Impact on foreign investment. Countries with favorable labor laws might attract more foreign investment, boosting the stock market. Conversely, stricter labor laws could deter foreign investors, leading to a potential decline in stock prices. Case study. Adani Power share price. To illustrate how changes in labor laws can impact stock prices, let's consider the Adani Power share price. Labor costs and profit margins. If new labor laws in India were to mandate higher wages for workers in the energy sector, Adani Power might face increased operational costs. This could lead to a short-term decline in its share price as investors anticipate lower profit margins. Long-term stability. However, if these laws lead to a more motivated and stable workforce, it could improve productivity and reduce turnover in the long run, potentially boosting the company's performance and share price. 5. How labor laws influence market valuations. Earnings projections. Analysts often adjust their earnings projections for companies based on changes in labor laws. Lower projected earnings due to higher labor costs can lead to lower stock valuations. Risk premium. Stricter labor laws might increase the perceived risk of investing in certain sectors, leading to a higher risk premium and lower stock valuations. Impact on dividend policies. If a company's profitability is affected by new labor laws, it might have to adjust its dividend policies. A reduction in dividends could lead to a decline in stock prices. 6. The role of labor unions. Collective bargaining power. Stronger labor laws often empower labor unions, giving them more bargaining power. This can lead to higher wages and benefits for workers but also increased costs for employers, affecting stock market performance. Strikes and disruptions. If labor unions push for higher wages or better conditions and negotiations fail, it could lead to strikes or disruptions. Such events can negatively impact a company's operations and its stock price. 7. Balancing worker rights and profitability. Corporate social responsibility, CSR. Companies that embrace labor laws and prioritize worker rights might be viewed more favorably by investors interested in ethical investments. This can positively impact their stock prices. Profitability trade-offs. However, there's often a trade-off between upholding worker rights and maintaining high profitability. Striking the right balance is crucial for companies to ensure stable stock market performance. Global examples of labor law impacts. The United States. In the U.S., changes in minimum wage laws have had varying impacts on different sectors. While some companies have absorbed the costs without significant impact on stock prices, others, particularly in the retail and hospitality sectors, have faced challenges. Europe. European countries with strong labor laws, such as France and Germany, often see less volatility in their stock markets during times of labor disputes compared to countries with weaker labor protections. This stability can attract more long-term investors. Conclusion. Changes in labor laws have a profound impact on the share market and stock prices. By affecting business costs, investor sentiment, and sector-specific performance, labor laws play a crucial role in shaping market dynamics. Whether it's the Adani Power share price or stocks in other sectors, understanding the implications of labor law changes is essential for making informed investment decisions. In summary, while stricter labor laws might pose short-term challenges for businesses, they can also lead to long-term stability and sustainable growth. As investors, keeping an eye on labor law developments and their potential impact on the stock market is crucial for navigating the ever-evolving landscape of the share market. Disclaimer. The following analysis on how do rupeezy changes in labor laws impact stock market performance is for informational purposes only. It does not constitute financial advice. Readers should consult a professional advisor before making any investment decisions.